All right, let's talk about Bank of Marin's third quarter earnings. Now, on the surface, it looks like a pretty solid beat, but if you dig just a little deeper, this quarter tells a fascinating story. One about a calculated risk, a painful decision, and a big, immediate payoff. This wasn't just another good quarter for BMRC. No, this was the payback quarter.
And you can see right away the market definitely saw something it liked. The day these earnings dropped, BMRC shares shot up almost 5%. For a small regional bank, trust me, that's a huge move. So the question is, what did investors see that got them so fired up?
So at first glance, it looks simple enough, right? A nice, clean beat. Earnings per share came in at 47 cents, a solid 5 cents better than Wall Street was looking for. Revenue squeaked by expectations too. And yeah, that's the kind of report card investors want to see, but a beat this size, it doesn't usually cause a 5% rally all by itself. So what's the real story here?
To really understand that pop in the stock, you have to look past those headline numbers. Because while the beat was great, it was the quality of that beat and, more importantly, what it signals for the future that really got people's attention. And this right here is the key of the whole thing. If you want to get why Q3 was so important, you've actually got to rewind the clock back to Q2. Management made a really tough strategic call that caused some real short-term pain, but it completely set the stage for everything we're seeing today.
And this was the pain. In the second quarter, Bank of Marin took a nearly $19 million loss on purpose. They decided to sell off a bunch of lower-yielding securities to reposition their whole balance sheet. It was a gutsy move, to absorb a head like that all at once, but it's all for one reason: to build a much stronger, more profitable bank for the future. And in Q3, we finally saw the payoff from that bet.
Which brings us to the core theme of this whole explainer, how that strategic pain they took back in Q2 led directly to a very tangible gain here in Q3. This is where the story gets really good. And this chart illustrates it perfectly. This is the payback. Net interest margin, or NIM, the core measure of a bank's profitability, it just exploded higher. It jumped by 15 basis points in a single quarter. For a bank, that is a massive move. It's the clearest sign you can get that the core engine of the bank hasn't just been tuned up, it's been seriously upgraded. And get this, management was incredibly specific about it. On their conference call, they said that 13 of those 15 basis points of expansion came directly from that big portfolio sale in Q2. So this isn't just a coincidence, it's a direct, measurable return on that nearly $19 million bet they made.
So here's the pain for gain trade in a nutshell. Before, the bank was kind of bogged down, sitting on these older, lower-yielding assets, basically playing defense. By taking that one-time loss, they ripped the Band-Aid off. They freed up all that capital to reinvest at today's much higher interest rates, fundamentally boosting their earnings power and signaling a huge shift from defense to offense.
Now, a higher margin is fantastic, but investors also needed to know that the rest of the business was healthy too. And on that front, well, management delivered a whole bunch of positive signals that just screamed confidence. And this wasn't just one good data point. It was a positive trend across the entire business. Loan originations were the highest they've been in over a year. Credit quality, a huge concern for all regional banks right now, is actually getting better. And maybe most importantly, they turned the buyback machine back on, buying their own stock at prices below its tangible book value. That's a huge vote of confidence. And the commentary for what's coming next was just as strong. The CEO, Tim Myers, didn't beat around the bush. He said straight up that the pipeline for new loans heading into the fourth quarter is strong. That is exactly the kind of clear guidance the market wants to hear.
Digging into the credit story a little more, it's really all about proactive management. Their cushion for potential losses is still substantial. They had 0 net charge-offs, meaning no bad loans had to be written off, and they're actively working through any problem loans. In fact, they even noted that another $3.6 million problem loan was paid off in full after the quarter ended, which points to even more improvement coming in Q4.
So let's recap. We've got a clean beat. We have a clear strategic win on the profit margin, and we have a ton of confident signals from management. So what does this all mean for the stock from here? Well, this is our take on the next call.
This is the question every single investor is asking right now. That first easy 5% pop is in the rearview mirror. So is there still more upside from here? We think the answer is a clear yes.
Okay, so here's our thesis. Step 1, Q3 was not a one-off event. It was a fundamental turning point. The painful part, the balance sheet repair, is over, and the rebuild is just getting started. Step 2, our prediction. We expect this momentum carries right into Q4, which is going to force analysts to raise their earnings estimates. And that brings us to Step 3, our rating on the stock. Outperform.
Now, to validate this whole idea, here are the 4 things we are watching like a hawk on the next earnings call. Can they keep that loan growth humming? Can they hold the line on how much they're paying for deposits? Does that new, shiny 3.08% profit margin prove to be a new floor? And do they keep buying back their own stock? If the answer to most of these is yes, we think the stock will continue to climb higher.
And that really leaves us with the big picture question. Bank of Marin just proved it can pull off a smart, even if painful, strategy to get its house in order. The challenge now is whether this small-cap bank can keep punching above its weight and out-executing its peers in what is still a very, very tough environment for regional banks.
And as always, just a quick reminder as we wrap up. The analysis in this explainer is for informational purposes only and should not be considered financial advice.